Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now in today's episode, we're going to take a look at the various dynamics that portfolio managers can use in order to provide you with the best return on your investment. Now so often we've heard about the debate regarding active versus passive investment, but of course we'll understand how both can actually be used to make sure that you get a solid return on your portfolio. Joining me in studio today, I have both my guests, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron, who's a portfolio manager at Vestact. Gentlemen, great to have you with us here today, and of course, intriguing conversation, which always gets into the debate of, active versus passive, but we'll steer it in the right direction today to make sure that we actually understand how both can work in a portfolio. But Andrew, your quick refresher for the audience regarding active versus passive, and of course, how both can be used if Old Mutual is using it.
Yeah, so I think the whole active-passive debates, I think we've spoken, that's been spoken about ad nauseum. I don't think we need to, rehash that. I think it's a hugely exciting topic to think about when you start thinking about not necessarily passive, but ETF or exchange traded funds, as they're called. I think there's a misunderstanding that ETFs are immediately a passive vehicle. Mm-hmm. A lot of them are, and as you say, they come in then at very low cost, a lot lower cost than what an active manager does. But ETFs can also be active. You can have active ETFs that you can get exposure to specific themes, geographies, sectors, whatever it might be. There's even a marijuana ETF, believe it or not.
Oh, wow.
So I think active managers tend to get quite defensive when you start talking about ETFs, and then the whole debate will wait until the market drops, and then you're going to see who's really doing their job. But I think you actually need to embrace this ETF, and you can use them together. Active managers can use ETFs to get exposure. We can talk about a number of ways that you can do that and why you might want to do that. But just pushing them aside and saying, this is passive versus active, I don't think we can do that anymore.
Yeah. Byron, what are your thoughts, especially from a Vestact point of view, where we have seen the markets being fairly muted, and of course fighting to get that alpha has proven to be quite a challenge?
Yes, especially on the local front.
Yeah.
I agree with Andrew. You can buy into an ETF that is essentially you buying into a diversified portfolio. Some of them are just trackers, and they'll track the indices, and they sort of self-manage themselves because there'll be a market cap indice, and as companies get bigger, they get more influential, and as companies get smaller, they'll get pushed out of the ETF. But you can actively be selecting ETFs. There's a group of guys in the US called Ritsalt's Wealth, Josh Brown. He's got over 1 million followers on Twitter. They're fantastic to follow on social media. They've got a big presence, and they've written a lot about this kind of thing. Michael Batnick recently wrote a really good book about it, about the biggest failures of investors. And their sort of conclusion is to go into these ETF type products, so you miss out the MTNs like we had yesterday.
Yeah.
But it's still very active in selecting those ETFs and selecting sectors that you like and regions of where to invest. So there's still a lot of thought process behind it.
Quite a tricky scenario, but of course we also know that when it comes to well-known international investors, Warren Buffett's name constantly comes up, right, when it comes to passive investing. Are there some tricks of the trade that we could learn from the, of course, giant that he is and leader of Berkshire Hathaway here?
Well, there's two sides to that story, because Warren Buffett's a stock picker and a company picker, yet he says that once he dies, he wants the majority of his family wealth to go into ETFs. And then he had this big bet against hedge funds, ETF versus hedge funds, and the ETF is absolutely crushing the hedge fund over a bull market period, which is not normally the best for hedge funds. So yes, he does like ETFs, but he obviously backs himself to outperform those ETFs with his own brain. So.
Yeah, and we know that kind of support that's often come through Coca-Cola and many other stocks that he's quite keen on. But what does this mean about performance, right? Because with ETFs, slightly safer, but are you missing out on that opportunity to really shoot the lights out when it comes to finding those sweet spots in the market to actually enhance the performance in your portfolio?
No, I don't think so. So I think if you think, thinking about ETFs, there's, I was listening to a podcast last week, I think it was, and the guy was talking about ETFs, and he said you can essentially put them into two categories. It's your dirt cheap ETFs and then your shiny objects. And your shiny objects are the ones that are going to try and shoot the lights out, swing for the fences. And we can talk about a couple of them later, but there's innovation ETFs out there that are investing in new tech, disruptive technologies, that sort of thing. That I don't think belongs as a core part of your portfolio, but if you've got a type of core satellite type approach, that you can put it on the outskirts of your portfolio and it could do really well and give you that bit of a sweetener that you talk about, then absolutely. But then your dirt cheap ETFs, you know, your Vanguards that Warren Buffett talks about, 4 basis points, you know, that's what they charge for a global equity ETF. You know, now in South Africa, if you think about the South African offering on global ETFs, I think they charge about 50 basis points, you know, so, you know, dirt cheap is Vanguard. If you want to go for global equity ETF, Vanguard's definitely the one.
Well, let's provide our viewers with some insight into which ETFs to select. And of course, depending on just which particular sectors you might be optimistic on, there's one ETF or perhaps a variety for you to actually select from. Let's take a look now at the equity space. I'm going to take a bit of a twist and start with the international exposure, because for a lot of investors, we want to go offshore from a retail point of view, but they might be slightly apprehensive, right? But there are some locally available global ETFs that provide you with that exposure to international equities, right?
Yeah, absolutely. So there's a couple of them that you can buy locally. And I suppose, you know, if you think about a local investor wanting to get offshore exposure into the equity markets, if you just think about the FANGs, if you want to buy one share of each of those, Facebook, Apple, Amazon, Google, Netflix, it's going to cost you 56,000 Rand for one of each. So it's 5 shares. You know, not too many, you know, local investors are able to afford that. So if you want to go and build a decent portfolio that's got, you know, call it enough diversification, if you want, for a better word, you're going to need a hell of a lot of money to do that if you want a pure segregated portfolio. But you can go and then buy the ETF, you know, and you can put your 1,000 Rand, 2,000 Rand into an ETF on a monthly basis and gain your exposure that way. You know, similarly, if you think of a multi-asset class portfolio, you know, in similar vein, if you've got a R1 million multi-asset class portfolio and you're allowed to take 25 or now 30% offshore, you know, that's 300,000 Rand. It's not really big enough still to go and get that offshore exposure. So in a multi-asset portfolio, and this is where PCS uses a global equity ETF, we would buy, you know, an ETF for clients in that scenario. So there's definitely uses for them. Yeah.
Just on that one though, there are quite a variety available, right? You've got the DBX trackers and many others that might be available. How should you actually be selecting an ETF that actually speaks to your investment needs?
Well, I suppose it depends what the client's you know, end goal and what the strategy is for the portfolio. So you talk about, you know, there's a Dividend Aristocrat ETF, which is, you know, investing in companies that are, you know, not necessarily paying high dividends, but are paying sustainable dividends. You know, now if you want, or if you're investing in an income generating portfolio, that would be a fantastic ETF. If you don't have enough money to take the positions yourself, you can buy the Dividend Aristocrat ETF, which will deliver the income for you from offshore. So I suppose it depends on a needs for needs basis.
There's also a semiconductor ETF that you brought up, and is one that we should potentially look at. For a moment I slipped back into my science class and thought about electricity and a circuit, but I'm assuming that's not the case here, right?
No, so I know Byron likes the semiconductor space as well.
What is the semiconductor space?
So if you think about, you know, the tech evolution that's happened, you know, starting in the 70s with the PC, you know, and then it's gone all the way through to the internet, smartphones, whatever. Now we're at the big data and Internet of Things, and everyone's got a computer today, whether it's even your smart fridge at home, your cell phone, I mean your smart fridge, your smartphone, your car, whatever it is, everyone's got a computer in their hand, and the semiconductors is what goes into the processors and the memory of these devices. So you can imagine this big data theme. We know what's happening in these tech companies that are collecting data all the time. You know, the demand for semiconductors is huge. There's a lot of companies that do it, and which one is going to be the winner, we're not 100% sure. So you want to get exposure to the theme.
Yeah.
One way is to go and buy the ETF, which is made up of all the large players in that space.
Well, let's talk about those companies. There's one that you're quite keen on, Nvidia, right, Byron?
Yeah, that's correct. Yeah. So I mean, I'm obviously a stock picker by nature.
Yeah.
So you know, we tend to like certain themes, and we certainly like the semiconductor theme. And then it's our job to go and, you know, find who we think are the best players in that sector. And you can have more than one in that sector. You know, social media, you can own Facebook and Twitter, or, you know, online advertising, you can own Google. You can spread it out amongst the sector. So Nvidia itself is a graphics processing chip manufacturer. They originally started making these graphics chips for gaming. But they just seem to be yards ahead of everyone else. And I mean, the gaming revolution has been massive, but the usefulness of these chips has just expanded drastically. The big growth area now is data centers, because these chips can process so much more information. So all the cloud storage companies like Amazon and Microsoft and Google have to buy chips from Nvidia to process all the information that's going through all these websites. They recently released a new chip called Turing, after Alan Turing, the British scientist who almost won World War II single-handedly. So this chip has the ability to track movement in terms of the graphics processing, and it's going to be huge for movie makers and of course gaming going forward. You can see shadows in games, and so it's really cool stuff. It's also for self-driving vehicles. So it obviously takes a lot of hard work and a lot of analysis to look at who out of these companies are doing what and doing the best. So I agree with Andrew, if you like the space, an ETF is pretty good, because Nvidia, I think, is the second biggest position after Qualcomm in that grouping. But if you've got a bit more time, then you can go and have a look at these companies and what they're doing. It's pretty exciting.
I was about to say, given the dynamics of this company that you were highlighting, clearly capital intensive, research and development. So there are some significant risks here, right? You're not really buying it for a dividend, perhaps, because they're likely to reinvest that capital into the organization. How does that reflect from an ETF performance versus what you've seen from the stock itself, whether it's capital appreciation or the divvy benefit for the investor?
Well, certain themes will have different growth trajectories and growth expectations. So Nvidia trades at about 50 times earnings because it's been growing earnings by 30-40% per annum for the last 4 or 5 years. It pays a piddly dividend. I don't even know why they do it. It's a bit of a waste of time. But they are reinvesting a lot of their money into creating new chips. So if you like a specific theme, and you think it's a growth theme, then you'd buy an ETF for capital appreciation. You wouldn't be concerned about the yield.
I think it's, so I mean, from our point of view, it's quite a tricky space to pick who the winner is going to be over the long term. So an ETF might make sense from that point of view. I also think of a lot of these semiconductors as commodity companies. They're price takers of DRAM and RAM pricing. And as a result, you see they're fairly cyclical. If you look at the likes of Taiwan Semiconductor, Micron's another one, you see it's a very cyclical industry. So I suppose to get a more diversified exposure, the ETF is an option to go for.
Yep. Well, we'll explore more ETFs for you to consider, some of them in developing economies and some even in the innovation space, with some highlights from the stocks that are entailed in those ETFs. We're going to take a quick break, but we'll be back right after that. In the meantime, join the conversation on social media by tweeting at CNBC Africa, #PortfolioWatch, or send us your questions and suggestions to portfoliowatch@abn360.com. We'll see you right after this break. Welcome back. You're still watching Portfolio Watch, where we're taking a look at interesting exchange-traded funds and the use of both active and passive management in building your portfolio. While joined by my guest today in studio, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron, Portfolio Manager at Vestact. Now, we certainly touched on some of the dynamics that we're seeing with regard to offshore ETFs that are available for local investors, and of course taking a look at the semiconductor space. But just last week we spoke about emerging markets, right, and the opportunities here. So despite the concerns that we see with Venezuela and Turkey, but some sweet spots in Japan and China. And whenever we talk about that particular market, Tencent comes to mind, right? Let's actually build up on the theme of ETFs in developing markets, and if we've actually seen sustainable growth and profitability coming through from the performance of those ETFs, Andrew.
Yeah, so I think we spoke about emerging markets last week, and we know that this year hasn't been a great year despite a strong start in the beginning of the year. Emerging markets have come under pressure, partly because of Turkey, partly because all of them have their own fundamental issues in various places. But if you want to invest in emerging markets, and we again spoke about this, you sit behind your desk wherever it is in the world and you think you know what's going on on the ground in India, you're fooling yourself. You need to be, a manager needs to be on the ground, visiting these companies, kicking the tires, so to speak, which a lot of managers don't have the time to travel, all the way around the world, visiting these companies. So if you want to get that emerging market exposure without having to build up a huge emerging market team that visits these companies, obviously an ETF is a great way to go about it. China, we obviously always talk about China being the big, emerging market, but India is up and coming, and I think it's important that portfolios, if you invest in emerging markets, you have exposure to India as well as Latin America. There's some fantastic businesses in Latin America as well. So if you had to use the iShares MSCI Emerging Markets ETF, you're going to get exposure to all those countries.
Well, we mentioned quite a few sectors that were quite ripe for investment last week, but of course technology and tech still lead the front there. Tencent, clearly one of the stocks that you like that is part of this ETF, right, Byron? Does it still hold the fundamentals? Because we know for South African investors, you think Naspers, you think Tencent, you think the valuation. Is it still worth it?
Well, Tencent has actually pulled back quite a lot recently, and hence that index has underperformed slightly, along with other issues of emerging markets that we've seen come through. A lot of these companies have become so big that you could even consider them ETFs in their own rights. A company like Tencent has stakes in businesses all over the show. It owns 5% of Tesla. It owns a stake in Activision Blizzard, stakes in Epic Games, all about 6 or 7 big US-based gaming companies. It turned out they had a stake in Flipkart, which was a massive online retailer in India. So these very profitable tech businesses are using their core business to make cash and then go and use that money to go and invest in many other businesses all around the globe. So as an investor, you can pick a stock like this and back the management team to go and make good decisions, because they're the ones on the ground floor and kicking the tires and looking and seeing where they see these growth trends. And then you sort of, you sit and ride the wave. And I'm not saying you put all your money in a company like this, but it certainly warrants an allocation in your portfolio.
I was about to pick your brain on the difference that we see with regard to tech stocks, whether it's in Asian markets, like what you've mentioned with Tencent, versus the FANG stocks, right? And the trend that we see in developed economies there. Are there any particular nuances or favorite and best performing ETFs or stocks that you've witnessed?
Well, recently there's been a bit of divergence where Alibaba and Tencent have pulled back, whereas the FANGs, other than Facebook, which has had its own issues, has really outperformed. I mean, Amazon's above 2,000. It's looking to touch that $1 trillion mark. Netflix has pulled back a bit, but Apple's been incredibly strong. I saw Warren Buffett bought a bunch again yesterday, apparently. So the US-based ones have outperformed. But I mean, the US economy is growing at 4% and off a massive base, and these businesses are reaching their tentacles all around the globe. So for good reason. I think the 10-cent pullback is probably just a little blip in its long growth history. There are issues. In fact, again, last night there was an announcement that China is clamping down on gaming and the addictiveness of this, and Tencent, I'm pretty sure, Naspers will be down on the open today. So there are certain issues at the moment for Tencent, but if you have a look at the graph of Apple over its 30-year period to $1 trillion, there were big speed bumps along the way. So companies, every single company goes through these issues. That's how they deal with them. That matters.
Well, that's certainly what we're seeing from the developing markets opportunity. So clearly some excitement coming through from there. But keeping with the technology theme, innovation is also one of those that continues to hog the headlines, right, Andrew? We've seen that growing, but of course increased attention being focused on it. What are we seeing with regard to innovation ETFs? Are they managing to lead the charge here?
Yeah, so I think innovation, it's suddenly become the new buzzword in disruptive innovation, but it's actually been going on for many, many decades. But, it seems to be ramping up right now, given the onset of all these big tech companies. But, to try and sit down and say, right, an Amazon is a tech business, or is it a retailer business, or is it a logistics business? I don't think you can put these tech or these disruptive innovation businesses into a single sector. So what a company in America is, it's called ARK Invest, what they've done is they've just gone and said, right, we're going to put it all together in a sector called disruptive innovation, and we're going to build ETFs that play towards those themes. And there are different ETFs that they build. Some are passive, so they've got like a 3D printing ETF, for instance, which is a passive vehicle. But then they've also got active ETFs. So then they've got their Disruptive Innovation ETF, which is a very active, it's investing in genome sequencing, autonomous driving, electric vehicles. I think Tesla is the biggest holding in that ETF. So it's playing right across the board, not just focusing on tech companies per se, but it could be medical companies, whatever area that these companies are involved in. So it's a very exciting, I think it's an exciting ETF. It actually won, I think, the ETF of the year last year.
Okay.
But again, I don't think this is something that you want to go and load up on and put it a big position in your portfolio. Okay. But if you want a little sweetener, then something like this would be very interesting.
Sweeteners are the kind of things that we like, right? But I understand Tesla is one of those that also features in that ETF. Despite some of its challenges, though, still a company that's on the right track, right, Byron?
Well, I hope so. It's been in the headlines recently, and not always for the right reasons. Elon Musk seems to be having a bit of a social media breakdown, but that can happen when you're working 150 hours a week and on two massive companies. I think the benefit of a diversity in ETFs especially comes in themes like this. Tesla can be binary. It's either going to save the world and spearhead electric vehicles and become the size of Apple, and every second car is a Tesla because they were first movers and they're selling batteries to all the other EVs out there, or Elon Musk has a mental breakdown and the shorts crush the share price and he has no access to capital and goes to zero. It's binary. And I'm going on a bit of a tangent here, but biotech is very similar. Biotech we think is extremely exciting. That's the use of genomes to cure diseases and find cures for diseases. And there's some massive players out there. So you could either buy a biotech ETF, or you could go into and research what these guys are trying to cure and maybe try to find some information about how well they do, and either they get an FDA approval and they explode, or they don't and they go to zero. It's binary. Or you could find a company like Amgen, which is a massive biotech company with $100 billion market cap and has about 7 or 8 drugs on the market already, and is using a lot of that cash behind the scenes to discover new ones. So they could be a biotech ETF in their own right.
Sure.
So you just got to weigh out your risk and have a look. Instead of buying the innovation ETF, you could say, okay, I'm going to buy 2% of my portfolio in Tesla and just see how it goes. Follow how the progress of the company is going. And if I start feeling uncomfortable, then I'll sell it. You can do that, and that's the benefit of having a spread out portfolio. But you can also go, like I mentioned with Tencent, these really big companies that are diversified in their own right.
Exactly. Tough one, and many technicalities naturally to bear in mind. And of course, a lot of the ETFs we've covered today actually do have a strong focus around technology, innovation, all these new fourth industrial revolution kind of companies. But what have we seen regarding trends in financial services, looking at retail, looking at significant divvy players? Are they still seeing at least a sustainable amount of return coming through on those ETFs?
Yeah, so you can buy an ETF that essentially, I think there are more ETFs out there, listed ETFs today, than there are stocks. So you can buy, you can go and buy an ETF that whatever your fancy is. If you want a SA financial ETF, you can get it resources. So you can get the dull and boring ETFs as well, if you want to call it that, or you can go for the shiny objects and go and, for the disruptive innovation ETFs. What we're busy with a product that is called your active ETFs, where we're going to build a portfolio that is just made up of 10 or 15 ETFs, but it's actively managed. So it's an actively managed ETF portfolio that will give you exposure to specific themes that we identified, geographies, sectors, etc. So that's another way that you could actually use your ETFs, I suppose, to get a low cost product but get the exact exposure that you want.
Byron, when we started the show, we did talk about the very muted market environment that we've seen. Whilst there's a bull market in the US, but South African equity is certainly underperforming. How do you balance some of your client concerns, whether they choose to go via stocks or using ETFs, regarding patience, right? Because it's all about long-term investing and not really being swayed by a lot of the short-term headwinds.
Exactly. I mean, equities historically has outperformed every other asset class, and the reason for that is because it's tough. There are tough periods that you have to stomach. Those returns don't come for free. You have to be able to weather those storms. ETFs can make it a little easier because they are more diversified, but you do need to know what you're looking for. One of the, if you do a lot of reading into this, one of the main reasons ETFs can outperform stock pickers is because of fees. But now ETFs have become so complicated that you need a professional to tell you what ETFs to buy, and he's going to charge you fees. So there's going to be 2 layers of fees, because the ETF will have an underlying fee, and then the ETF selector will have fees. So you've got to know what you want. If you just want to track the market, do it on your own, go straight to the service provider and just buy in every month into an index tracker. But if you like the shiny ETFs, like Andrew talks about, then you're still going to need advice on that. Guys who will know which themes and jurisdictions and geographies and where to invest. So you've got to know what you're looking for and what you're comfortable with.
Yep, lots of research required, huh?
Yeah, I suppose the one thing very quickly on ETFs and why they came about was not just the cost thing. It's essentially like a unit trust, but except it's traded daily. You can go onto your online trading account and buy ETFs, which you can't do with unit trust. And I think that introduces a different angle that comes in the form of behavior. And when investors get nervous, we know what they do. When the markets go down, they sell. When the markets go up, then they buy.
Yeah.
And in a unit trust, it's very difficult to get in and out because you can only trade at the end of the day. There's forms to fill in, all that sort of stuff. Whereas with ETFs, it introduces that behavior aspect, which might result in investors destroying value by trying to time and get in and out at the wrong time.
Yeah. Well, like we always say on the show, it's all about patience and knowing what your investment objectives are, and of course seeking advice from the right kind of people, like my guest today, who can offer you some value in understanding just how to highlight and identify those sweet spots in the market. This is how we wrap up the show today, but a big thank you to both my guests, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Byron Lotter, Portfolio Manager at Vestact. Now, in the meantime, though, we also want to hear from you, so get talking to us by tweeting at CNBC Africa, #PortfolioWatch, or send your questions and suggestions to portfoliowatch@abn360.com. We'll see you here again, same time, same place, but from me, Gugulethu Mfuphi, and the team, it's goodbye for now.